Everyone, welcome to a new episode of Investing Fool. It's been a while since we recorded the last video, and we didn't record the last rebalancing instance as well in the beginning of February. So it's the middle of February now, and 15th was over the weekend. So we have rebalanced the core portfolio today as per the data at the end of 14th, and we will discuss about the rebalancing. But there are also a couple of general things that I wanted to share about the channel and the content that goes on here and how it might change a little bit going forward. So read this disclaimer first that whatever we show, be it stock names, be it ETFs, whatever, nothing is financial suggestion, recommendation, advice, influencing anything of that sort. Please do your own due diligence. Be cognizant of this fact that it's your money that you need to invest in. So be very, very careful. Take the help of financial advisors if needed to invest your money wisely. Before we get to the rebalancing part, right? I wanted to discuss a few things about the channel, and this is because of some recent like advice or suggestions from the regulator in terms of how finance related content is dispersed, that we may be taking a few steps to limit some kinds of information on this video. So for example, stock specific information or performance related information or current stock prices. There are a lot of things that I mean, sometimes it doesn't make sense to me personally, but if the intent is to, like, even though we say from our end, right, that like do not take any of this as a financial recommendation, right? There could be folks that may be taking it as financial recommendation. So as long as the intent is to safeguard the public, I think we would all need to agree with it. And so we would in due course talk more about general patterns, that general things that we are learning from tracking this portfolio, but limit the stock specific information as much as possible. So in today's rebalancing also, if like whoever has been following this channel for some time knows that we discuss specific stocks as well during the rebalancing videos, right? From now onwards, we would not be doing that, at least in the short to medium term. If it returns ever later, like returns ever, that's a different thing. We can talk about that in the future, but for now it seems that we are not going to be discussing which stocks we are exiting and entering and all that. Please note that like these information would be on the sheets, like, because I use that for my own portfolio tracking, right? So that sheet is public, that is live, and it is updated in real time. You can check it all the time. So anyone who is watching this video for the first time, we have been tracking a portfolio, a 20 stock portfolio. We started with a 20 stock portfolio with a notional amount of 20 lakhs invested in the top momentum stocks of Nifty 500 universe. We started this more than a year back, and we have been following it. There are very minor tweaks. The original intent was to publicly put out like how such a strategy actually performs, and in the recent correction you are seeing how it is performing and how it is tanking and how it is massively underperforming the benchmark, right? So but anyway, if you are very new to this channel, then this link to our core portfolio is, you can find it in any of our videos. But again, the intent is just to educate on how the strategy is performing. We are always focused more on the portfolio level than the stock level. We do not have any love or hate for any particular stock. There have been instances when the same stock has come, given us a loss, went away, again come, given us another bunch of loss, again gone back, and we have bought it again also, right? So there is like we follow the strategy, and as it points us towards stock, we just take it. If it performs, well and good. If it doesn't perform, well and good, we get out of the stock. That's in a nutshell, right? So if you want to be part of this community, you can consider subscribing to the channel. But so that's the general vein of what I was discussing, that some kind of information will be limited. General kind of information, how the markets in general are performing, how the sectors are performing and all that all is fine. We'll continue to discuss that. And again, all the information will be there on the sheet. So anyone, like all of you who have been following for so long, you many of you refer to the sheets as well. So you can continue doing that, but the caveat is, again, this is your own prerogative, and nothing is to be taken in the sense of a stock recommendation or anything, right? Okay, so let's get started. बहुत ज़्यादा ज्ञान हो गया, and if anything, like I'm saying this in a very free flowing way. If anything comes to my mind later, I might have missed it, then I'll probably make a second video for that. But let's talk about the meat of the content, the mid-Feb rebalancing. So the portfolio is like, the pain in February has just continued from where we left in January. We saw a few green days, and so today I think it was overall stable. It gained some ground in the second half of the market, but the previous week or more than that, if you see, there were like huge red sessions, and everything, like everyone was feeling the pain, right? It doesn't matter what kind of stocks you are, but the pain was definitely more pronounced in the mid and small cap segments of the market. So our portfolio currently is at 30% drawdown, which is the max drawdown. So we were currently at the max drawdown. So this is really a painful phase for the portfolio, and there is a huge underperformance with respect to Nifty 500. So this is something that one should always be aware of, especially when dealing with high beta strategies like momentum. People always, so whenever the times are good, people see the good times and the good results, and they are attracted to it, like moths are attracted to flame, and they go and burn themselves, right? The moth actually gets burned, but in equity, no death or no joy is final. So the good always turns to the bad always turns to the good. So the good, if you are in the good and the good is continuing for a long time, well, enjoy the good. If you are in the bad, then you have to endure the bad and wait for the good. You can't just exit and leave, right? At least you shouldn't. Anyway, the portfolio currently is hugely underperforming, and anyone who thinks that momentum is an answer to all sorrows in the stock market, hate to break it to you, but it's not. No factor or no strategy is. So you should always be, regardless of what kind of strategy or what kind of investing you are doing, you should be ready to take some amount of pain, and sometimes the pain can be there for a long time. Okay, there was this huge red candle on Friday as well, and to put it in a nutshell, like almost all the gains since inception in the portfolio have been erased. So like everything that we gained in the last at least 1 year, they have gone. If we keep falling like this, right, the portfolio might even go to negative returns, right? This has happened with a lot of funds. This is nothing to be scared of, right? If so, there is always your starting point is going to define your initial returns. For some years, your starting point has a huge influence over that for some years, right? As you continue to increase that time, that influence of that starting point reduces. It never really like goes away completely, but it reduces to a lot of extent, to a significant extent, right? So it's in a way you can say it's really bad that so there can be two reactions, right? Either you come at a time when the market just turns and everything is bad for you, right? And you go away from the market. The other way one can look at it is, you came in the market, but you were shown a reality check by the market, and that incentivized you in a way, or made your conviction stronger, or made your learning stronger, so as to persist, because now you have seen the bad part, right? Of course, any bad can go worse and worse, that's a different discussion. But once you have seen a drawdown, like a 25%, 30% drawdown, you know, probably you are a better judge now of where your pain threshold lies, whether you want to change something on your asset allocation front, like things like that. And it gives you learning, because definitely the next rally is going to come. When it is going to come, no one knows, but everyone knows that it is going to come, maybe in a few months, maybe in a few years, we don't know, right? But it will prepare you for that phase. So you have to endure the bad phase in order to get to the next good phase, right? Because the next good phase will always come. Now, in terms of the portfolio update, so one thing, because we didn't make a video last for the last rebalancing, right? we had actually increased the number of stocks in the last rebalancing from 21 to 22. So those of you who have been following would know that after a large exit last year in 2024, we had increased from 20 to 21, and now we have increased from 21 to 22. So and the approach is very similar. So what happens is, when there is some big exit, right? There is a winning stock. You have like the quantum of win is a bit large, and that stock exits for whatever reason. There were a couple of big exits in the beginning of February, and there was one big exit like today as well. Okay, but what happens in general is, there is a lot of cash flow because these are big winners, right? So if the new cash, whatever cash you have got from selling these winning stocks, if you like allocate that cash to only the new stocks, then their starting weight or allocation in the portfolio will be much higher than some of the other stocks that are there in the portfolio. So either you can like distribute the extra capital what is there equally among all the existing stocks as well. So in a way, like, everyone's weight would increase a little bit, and overall your portfolio would balance. The other thing is, if needed, and this is a need basis for me, so I actually want to increase the number of stocks from 20 to 25. I will increase it like as and when these things happen, I'll increase it. So this time as in the beginning of February, I realized that opportunity, that okay, a couple of big wins are there, and I can afford to, with a similar allocation, I can afford to add a new stock. So at that time we increased the number of stocks from 21 to 22. In this rebalancing, it has stayed constant. We are at 22 stocks now only, and in the future we may go till 25. Okay. There is no real reason for this. Some of it is backed by research in terms of how much diversification impacts your portfolio. So you can check out a video on that in the description, in the video description. Okay. Now some trends on the portfolio is that portfolio is moving from mid and small to large cap. So you can see the this chart here, right, and the below one as well. So now large caps are almost like close to half of the portfolio. This keeps going up and down, but in the last few months we had seen that there were a lot of mid caps, and now the maybe like some large caps have not fallen as drastically as the mid and small caps, right? So and some large caps have genuinely like gained some momentum, at least when compared to mid and small, which have fallen quite a bit. And there are rules like stocks should be within 25% of the all-time high in our screening criteria, right? So when mid and small caps fall, like the median fall in some of these indices was around like 28-30%, right? So the stocks, a lot of the stocks have fallen below like 25%, so they don't qualify only. So multiple reasons because of which large caps are now coming more and more to the portfolio. Whether it's going to be a good thing for the portfolio or not, we do not know, right? No one knows. So this time we had 6 exits, right? So 3 mid cap, 2 small caps, 1 micro cap. These 6 exits, all of them have fallen more than 25% from their all-time high. Okay, and with this rebalancing, we had one like winner or consistent old winner which we had purchased early in 2024, or not very early but early in 2024, that has also left. And with this, all the old winners of the portfolio are gone. So like stocks which had significant gains and were there for a long time, those old winners are all gone, and whatever stocks are remaining in the portfolio now, all are either sitting on losses. Most of them are sitting on losses, and even if someone is showing some profit, it is very nominal, and it can get erased with one fall. Like a single fall would erase all of those profits. So that is where we are. Some exit metrics that I can probably discuss, which is the winner percentage, and I've shown 3 figures here. This is to account for the one missed rebalancing for which we didn't record a video. So the winner percentage, which is the number of stocks that win, right, the number of winning trades, that has declined because obviously, like we are taking one loser after another. We are getting into new stocks, and the stocks are then correcting, right? So it's like a rotating wheel. So you always place your bet on something new, then again it goes down, then you place your bet on something else which then comes up in the rankings, again that goes down. So it's a churning, it's a very painful phase. But the winner percentage has declined from 36.7% to 35.2%, and loser percentage has similarly increased from 63.3 to 64.8%. Now, average gain on winner has improved in the past two rebalancing, and this is because the winners that were there, I already told you, there were a few big winners that have recently left the portfolio because they have fallen more than 25% from the all-time high. So the average gain on winner has improved from 25.4% to 28.7% and now to 30%. So that is sizable. But on the other side, the average loss on the loser stocks have also worsened, right? So from minus 11% to minus 12.5% it is reached. So the divergence between the gain percent of the winners and the loss percentage on losers, that is increasing. The average holding period has increased. It has increased quite a bit, but this time also due to a few very quick losers, like which came and then immediately lost a lot of ground and are exiting the stock. Because of that, it has again come down a bit, but overall it has increased from 88.0 to 93.7 days. So on average, a stock is being held a little bit over 3 months in the portfolio. That's a good sign, but primarily it is because now this number again has increased because those old winners were there. So they were there in the portfolio for a long time. Whatever new has come in, like recently, they have a very like limited age in the portfolio. So from now on, we may not see a growth in this number. This number is likely to go down from now on, unless like I'm willing to bet that whatever stocks we have taken recently, they are going to survive for a long time. In the current market scenario, I don't think so. I think there is going to be a lot of churn. There is going to be a lot of pain. Even if we do not go down from here, we can just continue dilly-dallying around here, stocks coming, going, no one really showing a lot of promise. So that is where I expect the markets to be. This is the Nifty 500 chart. Ignore the moving averages. This is the weekly chart. So you can see the three drawdowns here, right? So this is the COVID drawdown, March 2020. This is the drawdown from October 2021. We hit a peak, and then like in the first half of 2022 and everything, we had this drop down. This is the current one that we are in, right? So the current drawdown for many investors' portfolios is knocking very close to what they saw during the COVID crash as well. So the pain is very real and it is severe, but where the bottom is, we do not know. I'm showing this only as an indication of what kind of falls we have encountered in the past. This time it is much more swifter than what happened in late 2021 and early 2022. But do note that whenever we face drawdowns, we may live or we may be in time correction for a lot of time, but the period after that typically is a very good period. So if you have to leave the market, if someone has to leave the market, this is probably one of the worst times to leave the market. That's all I'll say. Like if you have already fallen 30%, this point is probably not a very good time to exit the market. And we'll talk more about this. Let's continue. So what else? So you can see the sectors in the portfolio here, right? And you can see the IT and financial services are have the largest weight. So pharma used to have the largest weight, but sometimes the sector as a general performs, but the momentum names that are coming to your portfolio somehow do not perform. We still have exposure to pharma shops. But it's comparatively less than IT or financial services. If you look at how the sectors have performed, so in the last 6 months, only IT, I think, and financial service, these are the only two which have some sort of positive gains. You can see all the other sectors are negative. So over a 6-month period also, almost all the sectors are negative. So that's what that's when you know that the pain is severe. And as you continue rebalancing. So whatever sectors show promise, they will continue, they will trickle slowly into your portfolio. That's the idea. It may not always work out, but that is why you have to be with the strength and not with the laggards, right? So market bottom, many people are saying that we are very close to market bottom. Typically we never really know when the market bottom is. It is always known in hindsight, right? आगे एक महीने आगे जाके पता चलेगा अच्छा यहाँ पे bottom था, right? On the bottom day everyone is probably getting scared and selling everything left, right and center. But so market bottom by some accounts it may be near. That's what I also personally feel. Probabilistically we can say that, but no one knows. यहाँ से like if the market falls 10% from here, you are no one to complain, right? Ki, oh, you said that market bottom is near, how did it fall 10% from here? This is only based on probability of how like trends behave in like as per the last corrections, as per the historical trends of the market, right? So but yeah, there is no definitive argument to make to say, to suggest that the we have achieved the bottom, or we are very very close to the bottom, right? uh, Drawdowns, as I said, seen approaching COVID levels for many investors, and this is a good learning phase for all the investors. This is a point that I had discussed in the previous video as well, that the universe of investable stocks has come down quite a bit. So it is less than 50. So like in a universe of 500 stocks, you are getting less than 50 stocks which qualify for screening, right? So that is less than 10% of the portfolio. So 90% of your entire universe is just eliminated, right? You cannot even rank them, nothing, right? They are just out of contention. And as long as we are getting new stock names, we, like as a pure play rotational strategy, if we are to continue with this, we will remain invested fully, right? As long as this the number of stocks that we are getting for screening is more than the number of stocks we require in the portfolio. So currently we have 22 stocks. As long as we are getting 22 names, we would not go to cash. If and when, like let's say tomorrow, maybe more stocks fall, right? And no stock, like almost like only 10 stocks are left which haven't fallen more than 25% from their all-time high, okay? So only 10 stocks will be available for ranking. So we will buy only into 10 stocks. The rest will remain in cash. So that's the only situation in which this portfolio is now going, will now go into cash. Otherwise we'll keep investing as per the names that we get on each rebalancing day. Sorry. One point is that yesterday's winners may not be the ones to recover tomorrow. So please always remember that. So do not just leave something midway, right? If you have to continue remaining with the strength, you have to continuously identify the strength and remain invested in it. You cannot just abandon something midway, because uh, what worked yesterday may not work tomorrow. There will be new like winners that we can only say in hindsight, but momentum or price performance may be giving some signals in earnest to you to remain with those stocks, okay? Even though it might feel in these situations key rebalancing is not helping, right? I'm just getting into new stocks, they are again losing, everyone is losing, I'm just losing money with every rebalancing, right? It might sometimes feel better to not do anything, right? And we will compare that as well once, like whenever hopefully not years, but whenever we hit we reach our all-time high of the portfolio NAV, we'll again do a comparison of what would have happened if we had gone to cash based on some regime filter, maybe some lagging indicator, some simple lagging indicator like 200 EMA or something, which we used to use, versus being in a pure play rotational strategy. So we can make that comparison. We can also do other comparisons as to how the portfolio NAV with a 30% gold, 70% momentum, how that would have performed, how much of like smoothening would have happened in the equity curve because of that. That also we can do. But at least this cash call comparison scenario will probably do after we recover fully from the kind of market that we are currently in. Okay, so anyway, the base point was to continue with your strategy, to continue to stick to your strategy, continue all the rebalancing as per your strategy. And personally, I so gold has run, you must have realized and noticed that gold has run quite a bit in the recent times. And I had always been saying in my previous videos that I have been accumulating gold and to gradually increase my asset allocation. It has nothing to do with this momentum portfolio, but in the overall scheme of things, I first wanted to take it to 25%, and now I've set a goal of 30% for now. 30% I had discussed previously as well, I think, on one of the videos. But in the very short term, for now, I have paused buying gold. I feel that it has stretched, like it has given really good returns in the very recent past. So I feel that there could be some bit of mean reversion. So I have paused buying gold for now. If the mean reversion doesn't come, or if it just continues to stay there, right, then I will reinitiate my periodic additions for gold. And this is to go towards a goal of 30% in the overall asset allocation. But yeah, for now, gold is the only thing that is giving some respite to the equity part of the overall pie. Okay. In terms of passive investing, if you are holding passive funds, ETFs, whatever, for the long term, right? It's tax efficient. You do not have to pay tax for decades, right? And that money which you would have paid in tax, that remains invested. It keeps it keeps generating more returns for you as well. If you are in that camp as a passive investor, this I feel is a very good time to gradually accumulate ETFs and index funds that you follow or track. I personally do track some of the NSE created momentum ETFs and index funds as well. And just to try out, I do put out like I do allocate during these times to such index funds as well, although the exposure would be fairly limited compared to my core momentum portfolio. So that is what I have been doing. I'm not sure how long the video has stretched. Okay, it's almost half an hour, so I'll take a pause here, and if anything else comes to my mind, I'll share in the comments below. But let us know how you have been doing in the market currently. What steps have you taken to probably mitigate some of the downside on your portfolio? And yeah, that's pretty much it. Subscribe to the channel, like this video if you like the content, and I'll see you in the next video. Till then, take care. Bye bye.